After Sam Bankman-Fried told Forbes that some third-tier exchanges were secretly insolvent late last week, rumors circulated the internet that KuCoin was a prime suspect and that they were about to start halting withdrawals. These FUD rumors also urged KuCoin users to withdraw their money off of the platform immediately. It's not the best look that KuCoin's native token KCS has fallen from around $18 to just above $8 since the start of the month. But in defense of these rumors, KuCoin CEO Johnny Liu has been very active on Twitter defending his project and proving that the FUD is nothing more than FUD. He stated that KuCoin has zero exposure to Luna or Three Arrows Capital. Since KuCoin is running at full capacity, there's no plan to halt withdrawals. Liu also pointed out that KuCoin is still hiring, fundraising, and using the bear market as an opportunity to build the platform. We've got that in common. The rumor that concerned people the most was the claim that KuCoin only had 300 Bitcoin in their wallet. That was also put to rest yesterday when Tun Kong Hu tweeted a Glassnode chart that proves there's over 16,000 Bitcoin in their wallet. This bear market is the time when we find out who will sink or swim. But to make fake accusations against a platform without your facts figured, well, it's just not only disingenuous, it can be slander. Liu didn't hesitate to say that KuCoin reserves the right to take legal action against those who spread unverified information. Considering what one bad rumor can do to a company in times like this, probably should. Lost almost $1.3 trillion since the start of 2022. Makes complete sense that a handful of projects and platforms are going to drop like flies. The latest of the bunch that's facing challenges is the lending borrowing exchange, Vald. As a result of them seeing almost $198 million in withdrawals since June 12th, to stop the bleeding, Vald made the tough decision to suspend all withdrawals, trading and deposits on the platform. As a result of Vald's insolvency, Nexo has stepped up to the plate and disclosed their plans to acquire 100% of Vald and reorganize its future operations. Right now, the two companies are in a non-binding contract known as an indicative term sheet, which grants Nexo a 60-day exploratory period to figure out the terms and conditions of the potential acquisition. At the end of the 60 days, they will decide if they want to go through with the buy or drop it altogether. Could depend on Bitcoin's price. Hopefully, Nexo can stop the Vald ship from sinking since they claim they're one of the few crypto companies left that are in a position to help distressed businesses. In America, for some reason unbeknownst to me, the powers to be want to regulate crypto assets under the same pre-existing umbrellas used to regulate normal securities and commodities. Dirty Gary Gensler even proposed to put all crypto under one rulebook, regardless of this distinction. There's a growing opportunity that's primed to be the future of finance, so it needs its own regulating body, right? Well, it's safe to say that the UK is handling this issue much better than the US since they are growing a new regulating body specifically for digital assets, something I've said we need for years. The FCA, the UK's Financial Conduct Authority, has recently appointed Matthew Long to Director of Payments and Digital Assets, a new unit designated to regulating crypto. Long has spent plenty of time chasing those who commit crimes, as well as economic crimes, since he's a former police officer, as well as the director of the National Economic Crime Command. It's already common knowledge that the UK fully intends to become a crypto powerhouse, but it's still unclear on whether or not they will pursue their own CBDC. Instead of pushing harsh over-regulation, they're actually seeking the public's opinion on how to tax DeFi instead of finding ways to eliminate an ecosystem they can't control. This level-headed approach to embracing crypto as an opportunity instead of stifling progression is a page the US should take from our friends on the other side of the Atlantic. Hate to say it, but Solana's been having quite a bumpy ride this year. Between a dozen power outages, the price dropping over 75% since the start of the year, and more recently losing $8.8 million from a hack on their liquidity protocol, Crema Finance, it's safe to say 2022 isn't exactly going in their favor. To add insult to injury, Solana is now getting sued by a Californian investor, Mark Young, because he claims that many members of the team took illegal profits from the sale of the Solana coin, which he also claims is centralized in an unregistered security. In the lawsuit, Young brings many things to light, such as the power outages, questionable loans, the legality of Solana's IPO, and the impact of their promotional efforts. Kind of sounds like a baby to me. CryptoNews.com reports that the plaintiff is requesting a jury trial and he's seeking damages and a declaration that Solana is a security. Not to agree or disagree with Mr. Young, but it did raise my eyebrows to see that in Section 7, the introduction of the lawsuit, mentions that Solana's website states they are decentralized and unstoppable. Section 9 of the introduction, it says, as of May 2021, insiders held 48% of the Solana supply. Doesn't exactly seem decentralized to me either, but we'll keep you updated on this case as it progresses. He probably's got a lot more whining to go. Let's pass it over to Frankie Candles for a market watch.